All right, guys, we're going to talk a little bit about market structure today. This is going to be a pretty good lecture, I think, because market structure is quite important in understanding, trends, what liquidity to be taken. Essentially, it's giving us pretty clear defined areas where we can logically put a stop loss and take profit. So within market structure, right, we have short term highs and lows, got intermediate term highs and lows, and we have long term highs and lows. Right. So in an uptrend, in an uptrend, we're going to see higher highs and higher lows. And in a downtrend, you're going to see lower highs and lower lows. Now, before we get into all this, we just need to understand what a actual swing point is. So a swing point will be any candle formation. So we need 3 candles, and the swing high is going to have higher low, or sorry, the swing high is going to have a high, a higher high, and then a lower high, and that makes a 3 candle pattern, right? So let me see if I can bring up a fractal indicator. All right, so these fractals essentially will paint when you have that 3-bar pattern, right? So we have this, you can see the high, there's a high, a higher high, and then a lower high. Here we see a low, a lower low, and a higher low. Same thing here, a low, lower low, higher low. So these are creating our swing points in the market. And you can see in a downtrend, right? We're going to have swing points printed on the way down. Now, these swing points can get violated. So that this is what constitutes a short-term high. So we have this high, a higher high, and then a lower high, right? But now it's violated, right? Until this next 3-bar pattern is formed. So these swing points will stay in place until they get violated. So that is how you determine what a swing point is. Let's remove that fractal. And we're going to talk about, short-term highs, the intermediate term highs, and the long-term highs. So what makes it a short-term high? In my opinion, on the daily chart, right, we're going to have, um, you know, a high, a higher high, lower high. That kind of makes a short-term high, just 3 days, right? But what makes it an intermediate term high? Well, it's the time aspect behind it, right? So we have this as so this is our intermediate term high, right? Because there's actual multiple days in here that are creating that swing high point. So we have this high, and this high, right? So this is creating our intermediate term high. Let's see if we can find an intermediate term low. We have this low, lower low, higher low. All right, so this creates our intermediate term low. So really, it's all dependent on the amount of time it takes to actually form that specific high or low. Now, what makes it a long-term high or low, right? It's the more time spent between them. All right, so we have a high, higher high, lower high, and look how much time is spent between this. You're talking about January of this year, all the way up until May, the end of May. So this is 5 months of time being created to create this swing high pattern. So that is how you're going to determine, what's a short-term high, intermediate-term high, and a long-term high. And we can simplify and just say this is a short-term high or a short-term low, right? ITH or STH or sorry, STL, ITH or short-term low, or you have long-term high or long-term low, right? And that's kind of just um, sh- shortening the name of that. Right. So now that we understand, what constitutes a long-term high, what constitutes an intermediate-term high, and what constitutes a long-term, high or low, we can get into actual market structure. So, in my opinion, the best way to study market structure is just using a line chart, right? You always see the graphics where they're showing you this, right? And this is our market structure, right? And the easiest way to see it, if your eye's not totally trained to reading candlesticks, is just by changing this to a line chart. Right. So we can actually study what is this actually doing, right? We're creating a high, a higher low, and then a higher high. So we can clearly see that this market structure is bullish, right? And then we have short-term lows being ran out, right? But this is intermediate term low is not. So, you know, it's essentially classic support and resistance where we have a high, it's being broken, retested, and then going higher. Same here, right? We have this higher low in place. We have this low, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So we have to really understand, even if short-term highs are being ran out, we could still possibly be in a bearish trend, right? So every time we possibly see short-term lows or highs being rated, right? If our order flow is still leaning one direction and our analysis is still leaning one direction, right? It's just providing us opportunity to get in sync with the market. So oftentimes you might not notice, maybe you're reading this as a market structure shift. Well, you're going to get stopped out. And that's okay. Like this is part of the market. Like we're playing probabilities here, right? So we can use, these market structure shifts, right? Let's say if we break this low and then we fail to break this high. And so if you zoom in here, so this is our short-term high, all right? So we fail to break that high, right? Well, we could possibly target the lows again. So that's our market structure shift, and this is this breaking down. So same thing here, right? We have this low being broken. This high is still in place. This creates our short-term high, this high, higher high, lower high. So the market structure is still trending bearish, right? And we obviously want to have lows marked out in time and see how it responds, right? Because once we get to some level of major discount, right? Possibly if I had a candlestick pulled up, we might have just taken out that low, right? The liquidity's been taken, and then we have a market structure shift, right? And then we have um, market structure shift here. This high has been taken out. We've created a higher high based on this short-term market structure, and then we're going higher to rate this liquidity. Right. So currently we can see that this market structure on the dollar index, we're still pretty bearish on. Like we have this short-term high that's in place. And until we get above there, I'm expecting lower prices still. Right. So we have this, even this short-term high in here. So that's essentially how you can read market structure. Understanding the higher time frame order flow is so important because a lot of times when we raid short-term highs or lows and we haven't reached into a specific premium or discount level, it's not an actual market structure shift and it's just a run on liquidity. Right? And we'll get to that in another video. But this is essentially how I read market structure. Um, Then we inside of that specific market structure, we'll have mitigation areas, breakers, et cetera, et cetera. Right. So this is a really good way of studying market structure is just pulling up a line chart and studying if it's creating higher highs, higher lows, running out short-term lows and running out short-term highs. Right. So we have these levels in here again, running out short-term lows. Right. There's trades in here to go short. Um, and it's mostly a sideways market, but we're essentially just trading order flow and these swing points, right? Every time it's retracing is providing us areas to place our stop loss. So let's say if we go long here, it's giving us an area to create our stop here, and maybe we're targeting here, right? Or maybe we're targeting a little bit above this equal high, right? So these swing points are providing us areas to put our stop losses, and that's how we're going to frame our trade. All right. So using a stop loss, you have to use market structure or some form of PD array, right? Which we'll get into in another video. But many times you're using market structure to place your stop losses. All right. There's really not too much else to cover in here. Just go back in your charts, back test all this information, three candle patterns, swing highs, swing lows, and understand what's an intermediate term high, what's a short term high, what's a long term high, and you know, vice versa for lows. So with that, I'm gonna sign off and I'll see you guys on the next one.